Hi, everybody. Thank you so much for signing in to hear our briefing. And what we're doing here, depth technical briefing for a new report that we're releasing today, which is called Getting on Track for 2020. And we are also going to be doing a short highlights version on Parliament Hill at 11:30 as well, just to run through some of the same ideas. So, my name is Claire Demers. I'm the Director of Federal Policy at the Pamela Institute. I'm going to do my presentation in English, mais je suis heureuse de prendre des questions en français s'il y a des questions en français. So, I'm hoping everybody can see the slides. Assuming that's the case, I will start moving on through those slides. And so we're just starting off with a quick little piece to say that we are a sustainable energy think tank. We've got offices across the country, and we spend a lot of time tracking oil and gas and climate change, which are the two things we're going to be talking about today. So running through the context very quickly. Oh, sorry, guys. I'm creating problems here. Okay. I'm going to get my more technically minded colleague to help me out here. Okay, awesome. So quick context, because I think most of you guys know the context. First of all, we think there is growing recognition in Canada that the oil and gas sector, specifically the oil sands, faces challenges, and that better environmental management would help with those. So obviously securing public support, or the jargon term being social license, and that also we're seeing increasingly access to markets, right, where in places like the US or the EU, environmental performance matters. They're looking at low carbon fuel standards. So for example, Premier Redford has recognized this, talks about the need to be prepared to push the bar higher in addressing climate change. So we're hoping that that context will play into the federal oil and gas regulations. In terms of commitments, so the current 2020 target that Canada has nationally was something we adopted in 2010, just after the Copenhagen climate talks. It's the same as the US targets. So the government will often talk about being harmonized with the US, and that's usually what they mean. And the approach that the government has taken is, as we all know, they're not in favor of economy-wide carbon pricing. They're looking at a sector-by-sector approach. So, going through heavy industry, one sector at a time. And in two cases, in terms of vehicles and coal power, those regulations are already out there. They are on the books. And in 2011, the government committed to regulations for oil and gas. So Environment Canada has been working at developing these regulations. They've got a so-called process working group with people in the oil and gas industry, the government of Alberta, and Environment Minister Peter Kent has said, okay, we're in the final stages, and they're hoping to share something publicly by mid-year. So what we are looking at today is what we think that should look like. And then final piece of context, I just always think it's useful to throw this one in, where our emissions come from. 2010 is the most recent data we have, because there's always a 2-year lag in greenhouse gas national data. So the little piece of the pie we've pulled out there, what we're talking about today, oil and gas, is currently nearly a quarter of Canada's emissions at 22%, and that is projected to grow. And so there we've got that growing to 27%, which is what we're projected to see by 2020 under current policies. So looking specifically at the oil and gas regulations and what it's going to take, you probably won't be surprised to hear we think strong regulations are good news. So obviously it helps to tackle climate change. That's good for Canadians, that's good for the world. We also think, however, that strong regulations are good for the oil and gas industry itself. They provide certainty about the rules of the game, so that companies know when they're making these investments where they need to look multiple decades ahead, what are the conditions under which they need to consider making those investments. strong regulations, flexible regulations create an incentive to innovate and to improve efficiency. That saves money. That leads to all kinds of benefits for the companies that are the innovators. And as we mentioned earlier, there's that critical issue of public support and social license. So, as we mentioned, the government has opted to go sector by sector. We wanted to say that although today's analysis, we chose to work within that box. We said, okay, what would an effective sector by sector regulation look like? That has not changed what is for us the fundamental, which is we would rather see, we think a better policy approach is an economy-wide price on carbon. It's more economically efficient, it's simpler to design, it's easier to ratchet it up. So that's not what we're talking about today, but we still think it's a really important policy choice that does need to be considered for Canada. So, to look at what the oil and gas sector needs to deliver, we said, what's it going to take to get Canada on track to hit its national 2020 target? And as I mentioned, this is a target that the government chose. This is not, a target from a previous government, a Kyoto target. This is the target that the government themselves adopted in early 2010, and that ministers in the government will refer to frequently when they say they are in line with the United States. Again, it's not the target that we would have chosen. As we've got in the slide, many analyses show that Canada should take on more ambitious action to deliver its fair share of keeping the world below a threshold of dangerous climate change. But right now, even getting to the government's target is a big commitment because we are currently very far from being on track to hit it. So this next slide, slide 13, is Environment Canada's slide showing where we are. And the key lines here are the purple line, which shows 720 million tons. That's where we're projected to be in 2020 under current policies. So already factoring in everything that provinces are doing, everything that the federal government has already done, they project emissions growing from today's level to 720 million tons in 2020. Where we need to be is that little kind of yellow line at the bottom, 607 million tons. That's our target. So the gap is 113 million tons, which is a significant gap. So you'll sometimes hear the government say, well, we're halfway there. And that relates to that red line on the top of the graph, which would be where they project we would be if governments in the country were doing absolutely nothing. But where we project to be, given what governments are doing, leaves this gap of 113 million tons. So got some of our analogies here. That's more than the current emissions of Saskatchewan, Manitoba, and New Brunswick. It's more than all the emissions from the electricity sector. This is quite a significant gap. And in this next slide, we look at what that means from 2010, so the most current data we've got, to 2020. So just to explain this slide a little bit, the dark red bar at the very top is where we think where Environment Canada projects our emissions will be in 2020 and what happens from the 2010 to 2020 period. And so that means they're going to grow. Where they need to go is the second line from the top in red, the one called national target. So they need to be way over on the left-hand side of the graph. And when you read down that list of sectors, the one that obviously jumps out on the right-hand side of the graph is oil sands. So the oil sands are a huge part of the reason why Canada is not on track to its 2020 target and why we are projected to miss that target. So when we look at, as I said, that trajectory, it already factors in a number of government actions. Looking at what's left, oil and gas is the biggest piece of the pie that's left to be regulated. So in our view, they're the ones that have to close the majority of the gap. And if you look at remaining sectors, the sectors that are not oil and gas could contribute, that seemed reasonable, and found that, okay, they can get us a quarter of the way there. That leaves oil and gas to close 3/4 of that gap. And so what that means, and that's sort of one of the key numbers from today's presentation, and I realize I'm throwing around a lot of numbers, but that means reducing the sector's emissions to 42% below where they would otherwise be in 2020, where they're projected to be in 2020. So that's a significant change. We've got a chart here that looks at oil and gas closing 3/4 of that gap, and then some of the other sectors up top being able to close that remaining quarter, getting us on track to our target. So we also have, looking specifically here at oil and gas, the solid line at the top of this chart showing where they're projected to go, 204 million tons, and where we think they need to go to hit the target, 118 million tons. So that's a 42% improvement. That obviously has implications. And from our perspective, one of the important implications is that it would more than halve the gap between oil sands bitumen and its emissions, the emissions associated with producing that fuel, versus conventional crudes. And that gap is really under the microscope right now because of clean fuels policies that are being proposed in the European Union, in California. So we've seen the government of Canada come out and say, look, we want the EU, California, to change the way they treat oil sands bitumen. And I think one of the conclusions we came to in doing this analysis is a better approach would be to change the emissions performance of oil sands bitumen by putting in place a strong regulation. So that's one of the clear benefits. Obviously, when we talk about a 42% target, the question comes up, is that realistic? And I think it's a safe bet that this is stronger than what most in industry are asking for right now. But it actually is very similar to what former Environment Minister John Baird proposed back in 2007, 2008 with an approach called turning the corner. So in that case, he looked at the oil and gas sector's emissions and said they should be reduced. They were projected to be reduced by 37%, and that worked out to 83 million tons below their 2020 projection. So we're talking about 42 and 86 versus 37 and 83, very much in the same ballpark. Obviously, this is turning the corner, is a proposal that was back in 2007, 2008, so industry has had a number of years of heads up that this type of level of emission reduction could be something that they would be asked to deliver. So this should not come as a surprise. Now, the other thing that we know has been really on the table from the federal government is Alberta's approach. So Alberta's model, Alberta has already in effect since 2007 an emissions regulation for all of heavy industry, not just oil and gas, but any industry facility over a certain size. And we are going to look quickly today at those parameters because we understand that the federal government is looking very closely at Alberta's model as a potential something to mimic in their own rules. So there's 3 key parameters in Alberta's approach that determine its environmental outcome: the intensity target, the technology fund price, and access to offsets. So we will look at a couple of those quickly. So as I say, this has been in effect since 2007. The target that they set in Alberta's approach is an intensity target. So a target, for example, of emissions per barrel of oil produced. And as many of you know, that does not mean an absolute cap on greenhouse gas emissions. As I say, we're working within this sector by sector approach. So if you want to compare our target that we're recommending today to Alberta's, we're recommending a 42% emissions intensity target. Then in terms of, we just quickly wanted to look at sort of the highlights of Alberta's approach. So it is something that was a pioneering policy. They are the first in North America to put a carbon price on all large emitters when they did that in 2007. And because it is a carbon pricing system, that leads to economic efficiency. Weaknesses, the price is very low. The average carbon price is $1.80 per ton, because if you multiply their intensity target of 12% by the technology fund price, which we'll come to next, which is $15 a ton. So that's obviously a low price signal. On a barrel of oil, it works out to under 20 cents per barrel. And as well, as we'll come to later, there have been questions about the integrity of their offset option. So that technology fund, what this is that rather than reducing emissions in their operations, companies have the option of meeting 100% of their target through paying into this technology fund. And the rate of payment is $15 a ton. And as we mentioned, what that means is it's very tough for any company to justify paying more than $15 a ton to reduce their emissions. So it effectively becomes a ceiling on the price that Alberta's system can send. Because the money is collected and then it goes through a process to determine which particular projects will be funded, and then they have to go ahead and do those projects, the reductions, if they happen, will happen well into the future. And in most cases, they're going to cost much more than $15 a ton. So all of these $15 that companies are paying into the fund are not each going to result in a ton of emissions reduced. So turning to the federal government, if the federal government decides they also want to offer a technology fund in their regulations, what should be the right price? So from our perspective, again, it comes back to that question of what is strong enough to get Canada on track for its 2020 target. So we did economic analysis back in 2009 that said you're going to need a price of over $100 a ton to do that. More recently, the National Roundtable, so 2012, found that $150 a ton is what you would need to get on track for the 2020 target. So we're saying our recommendation here is if there is a federal technology fund, the price should reach at least $100 a ton by 2020. If you want to be sure about hitting the target, $150 a ton would give a better chance of doing that. So we did a little bit of comparison to put this in context, and you see that table on slide 28. So we have the prices in the first column, and what we did here is we compared our recommended approach, which is at the bottom of the table, our lower bound $100 a ton, the higher boundary $150 a ton, to Alberta's existing approach at $15 a ton on 12% of emissions, BC's carbon tax, and Norway's carbon tax. Obviously, Norway's carbon tax, for example, does not apply in the oil sands, but we said if we took that model and applied it to a typical oil sands facility, what price point would it produce? And so the middle column we have there, the maximum compliance cost, is sort of for an existing facility, paying the maximum price, what does this work out to on a per barrel basis? The final column on the right, the effective cost per barrel, accounts for the interaction with royalties and corporate taxes, which mean that if you can effectively cut that cost in half. So what this means is what we're talking about here, at our higher price point, our higher boundary, would add about $3 per barrel to oil sands production costs. These are barrels that regularly sell for about $70. That's more than BC's current carbon tax is imposing. It's less than Norway's current carbon tax. So this is not in any way out of the realm of what actual companies operating elsewhere are already paying. Then final point from Alberta's experience is this question of offsets. And offsets are emission reductions from outside of the regulated sector. So for example, from small projects or from energy efficiency, renewable energy, rather than the big heavy industry facilities that are being regulated in Alberta. And like the tech fund, Alberta does not set any limit on companies' access to offset credits. So if they want, they could meet 100% of their target by buying offset credits. There is a limitation, however, in that these projects have to come from Alberta in the Alberta approach. And so what ended up happening in real world compliance with their targets, companies actually chose offsets, so in 2011, as the most popular way to reach their targets. So as we've got there, 46% of the way that they hit their targets was by purchasing offsets. Now, the integrity of the offsets in Alberta has come under question, not just from groups like ours, but also from, for example, Alberta's Auditor General. And that's because the key issue with offsets, or one very important issue, is whether they go beyond business as usual. And Alberta has given credit for a number of offsets that either started before their regulation, so clearly they were already economically viable even before this regulation came into effect, or from what are essentially already industry standard practices, for example, in agriculture. So the reality is it's very, very difficult to create an offset system with bulletproof environmental integrity. So a prudent government, if you do allow access to offsets, should build in ways to make sure there is more environmental integrity. And the number one way to do that is limit companies' access to offsets. Don't say that they can meet 100% of their target with this method. You could also set a fixed price for offsets. So that cuts out companies' incentives to go out there and find low cost and then potentially low quality credits. So we've got a few ideas of how to make offsets work better if the federal government does look to Alberta's model and allow that access to offsets. We also have a couple points that we flag in our report in terms of whether or not the government adopts Alberta's approach. Please ensure that the regulation applies to the vast majority of accurately measurable emissions from the sector. So that's emissions from combustion, but also things like venting and flaring, which also produce greenhouse gas pollution. It needs to cover both new and existing facilities, and because our emissions challenge is only going to get more serious after 2020, the government needs to be clear that whatever they announce in the short term is a first step, and that the stringency, the requirements are only going to ratchet up over time, because that's important information for companies that are looking ahead far into the future as they consider making investments that are going to last multiple decades. So our final slides are some of the key questions that we would hope people like you will ask, and certainly that we will be asking if and when the federal government releases its oil and gas regulations. So I'll flip through those, but I also just wanted to quickly run through some of the key points. So, what we took away from doing this analysis and this thinking about the oil and gas regulations. So it's clear from the size of the sector and the projected growth of the sector, particularly oil sands, which is Canada's fastest growing source of greenhouse gas pollution, oil and gas is really the litmus test for the government's sector-by-sector regulatory approach. And right now, obviously, as we mentioned, Canada is nowhere near on track for its 2020 target. So the oil and gas aspect of what the government is going to announce is a make or break moment for Canada's credibility in terms of climate change. Get it right, we could be on track to hit the 2020 target. Get these regulations wrong, and the target becomes incredibly difficult to reach. As we mentioned, the sector can take responsibility for its greenhouse gas pollution for less than $3 or about $3 a barrel. These are barrels selling for about $70. And as I mentioned, we think tough regulations would help the sector compete in a world where environmental performance matters more and more. So, key question to ask. Number one, will this proposal get Canada on track to hit its 2020 target? And if not, what is the plan for closing the gap? How much will this cost in per barrel terms? What does it mean in allowing oil sands to compete against conventional crude? What consultation process was used to arrive at this proposal? What options does industry have to meet its target? And then some of those other general regulatory design principles that we've just highlighted. So I think that brings us to the end of the slides. Thank you so much again for participating, and we would love to take your questions. Kevin?
So I'm not seeing any questions at the moment. Just a reminder that if you do have questions, you can either type them into the chat box at the bottom, or you can raise your hand in the top left of your dashboard. There's a button with a hand on it. If you push that, I'll unmute you and you can go ahead and ask your question.
Maybe we're just incredibly comprehensive.
A reminder, oh, we've got one question here from James Munson. Go ahead, James.
Hi there, how you doing?
Hi, James. Very
Hi
well.
Claire. Good. I just wondered if you can go over just quickly again the difference between the maximum compliance cost per barrel produced and the effective average cost per barrel. Just
Mm.
in you mentioned the interplay between royalties and taxes. Taxes. If you just go over that quickly, that'd be great.
So yeah, that's right. So when we did the maximum compliance cost, what we did there is essentially multiply the price by the target. So in the case of Alberta, price is $15 a ton, target is on 12% of tons, so 15 times 12, for example. So that part's pretty straightforward. When you look at something like British Columbia's carbon tax, the effective target there is 100% of tons. Um, Although there are some nuances there that we can get into if you really want the gory details. But again, it's pretty straight multiplication. They've got a $30 a ton price signal on, let's say, 100%. So do that multiplication. The effective compliance cost, the real cost that companies face, is lower. And economists like Andre Plourde estimate that you can discount it by 50%, so cut it in half, because companies can, by paying environmental costs, they deduct that from the royalty payments that are due to governments, and it affects their profits from a corporate tax perspective. So that means that although they pay more on one side, they're able to pay less to governments in other ways. So the effective sort of bottom line impact for companies is cut in half. And so what we did to create that second or that final column of that table is essentially just divide everything by two. And that's an approach that, we ran that by actually a number of economists working in this sector, and everybody feels a lot of comfort with that, because I think it is important to note that although there is the sort of the maximum number that you see out there, what I think companies are going to be paying more attention to is the bottom line number for them. So after the interaction with the other costs that they face in terms of royalties and corporate taxes.
Okay, so we have another question here from Joanna Smith. If you are comparing your recommendations to the turning the corner policy in 2007, 2008, how confident are you that the government will agree with that argument, given they have abandoned other environmental policies from that era, for example, cap and trade?
Yeah, that's right. So the government has effectively shelved turning the corner, and they moved in a direction after the election of President Obama of, quote unquote, alignment with the United States. So, I certainly don't expect the government to take turning the corner off of the shelf and adopt it instead, because it was a broader approach. It was not a sector by sector regulation, but we raised it today because we think it is relevant to show that that approach, which this same government did support, would have had an effect on the oil and gas sector, according to them, quite similar to what we're proposing today. And I guess from our perspective, one of the most important things there is from an industry perspective. The energy industry in Canada obviously was well aware of turning the corner in 2007, 2008. They were aware that there were numbers on the table of oil and gas emissions being reduced by 37% relative to 2020 business as usual. In fact, with turning the corner, the government projected that the oil sands specifically would reduce its emissions by 55% below business as usual in 2020. So industry then has had a number of years to think about this as a possibility. we know that a number of energy companies actually already build in what's called a shadow carbon price into their balance sheet. So they say, would it make sense to build this project if we were facing carbon prices of, $30 a ton, $40 a ton, etc.? So they run that analysis. They're already thinking in those terms. The fact that turning the corner was there and raised this kind of possibility means, I think, that it is very, very defensible for a group like ours to say 42% emission reduction from the sector, that the sector should take responsibility for that level of emission reduction. It's nothing new. It's something that's been proposed over the years, and it's something that industry should have already had on their radar for years now.
Bill, the $100 per ton price would be under an SGER intensity-based model, correct? How would that translate to a regular cap and trade CO2 price?
Mm. So that's right. So the price that we are talking about in this recommendation is based on the technology fund option in Alberta's specified gas emitters regulation, SGER. So that is not the overall, it's not a cap and trade system, the SGER. And the reason for that is because there is no cap. It's an intensity-based system, and so companies need to improve their emissions performance per barrel of oil produced. But overall, if companies are producing more barrels of oil, for example, total emissions can go up. And in fact, although Alberta has had this system in place since 2007, the province's emissions have gone up. And so that's partly because of the nature of the target. It's also partly because companies have lots of options to hit their target without actually reducing their emissions in their operations, including the technology fund. So the price that we talked about, the at least $100 a ton, would be a contribution rate for a technology fund. So if the government of Canada says, like Alberta, we're going to give companies that option of not reducing emissions in their operations, but instead actually just contributing to a fund that will be spent on new technology, what kind of a price do they need to charge to make that work? And from our perspective, making it work means getting Canada on track for its 2020 target. So we looked at what kind of prices you need to get Canada on track for its 2020 target. The answer being at least $100 a ton, closer to 150 in more recent economic modeling. So Alberta's system overall, as I say, it's not a cap and trade because there's no hard cap. It does allow emissions trading. So companies can reduce emissions in their own operations. They can also buy credits from other companies that have hit their targets. And then they have these options of the technology fund and the offsets. So, we'll talk about it as saying no cap, but trade. And our understanding is that the federal government is looking very closely at the same model. So unfortunately, they are not interested at this point in a true cap and trade system. As we know, they spend a lot of time in question period, or I guess right before question period, talking about why they think that's a bad idea. Obviously, I think that's unfortunate. But they are looking at a system like Alberta's. So whether the government will allow firms to trade amongst themselves, I don't know at this point. We'll have to wait and see what they announce. We would support that. We think that it makes the system more economically efficient, and we think that the system does need to send a strong price signal. So does that answer the question?
Or Bill,
Maybe I'll take silence as consent in this case.
to respond, yes. We'll move on to the next question then, and this one's from Felix. Do you expect the government to opt for environmental effectiveness when they will probably go for a minimal level to get Keystone XL put through the U.S., who are likely to go for a little higher than $20 carbon price themselves?
So Felix, sounds like you have some good intel on what's happening in the Keystone discussion. I mean, obviously, from our perspective, we know that the Keystone debate in the U.S., the Keystone process, is moving into the national interest determination. President Obama, Secretary Kerry are going to be looking at what they think is in the best interest of the United States. So it's obviously a highly political discussion, and it's way above my pay grade in the sense of I don't know what factors they're going to be weighing into. From our perspective, when we look at something like a Keystone pipeline, we would say, or in fact, any pipeline, we'd say we're not anti-pipeline in general, but right now, we believe the governments of Canada and Alberta do not have the right environmental management in place to deal with the consequences of the oil sands. And so we don't feel that it's the right choice to expand or to build infrastructure that would expand oil sands production. And Keystone specifically, we calculate that if that pipeline were filled with new oil sands production, that would enable a 36% increase in current oil sand production level. That's equivalent to over 4 million new cars on the road. So until the environmental management in terms of obviously climate change and greenhouse gases, but also air, land, water, species, until we've got that picture right, we don't see this pipeline as the right choice. So what that means for the government, what the government's going to do, I think it is clear right now that pressure from the United States, the high-profile discussion around Keystone, around low-carbon fuel standards, all of these things has made it clear to governments in Canada, federally, government of Alberta, even government of Saskatchewan. You see things, premiers and ministers in the Harper government going to the United States and coming back and saying, you know what, they're not looking to hear from us about energy security. They're not looking to hear from us about jobs. What they want to know about is the environmental management. So I think it has become clear to governments in Canada that environmental management matters and that it's important to get that piece right, not just for all the reasons that I believe these things matter, but also for the best interests of the oil and gas sector itself, right? I think as we've said throughout this presentation, if the world is moving in a direction of lower carbon and where environmental performance matters, you've got to get regulations like this right for the sector as well as for Canadians. So, will the government take that message seriously? We don't know. We're releasing this report hoping to start a conversation about what does an effective regulation look like? What does it mean? I don't know how the government is going to respond to those regulations. We'll have to wait and see, to those recommendations. We'll have to wait and see what their regulations look like. And we hope to see those before too long. But I think it has become incredibly clear that environmental management matters for Canada's oil and gas sector. And I'm really hoping that the federal government is hearing that message loud and clear.
So we have another question from Graham Langtree. It's similar to what Bill had asked, but maybe a little different. How is this approach different from a carbon tax that the government has steadfastly refused to adopt?
Mm-hmm. So first of all, I find it very unfortunate that the government has taken that position. Economy-wide carbon pricing is widely acknowledged by economists, by environmental experts, as being the most efficient way to go, the best way to go. So I don't believe that it's impossible to hit Canada's 2020 target without carbon pricing, without economy-wide carbon pricing. But what the government's done is essentially taken one of the best tools off the table. So they've tied a hand behind their back. They've made it more difficult and more expensive to get where they need to go. So, first of all, I really hope that they will eventually reverse their thinking on an economy-wide carbon price. I think what we're talking about here works within the government's framework of a sector-by-sector regulation. So this is not across the board carbon pricing. What we're talking about here is a price signal through a technology fund, and that's something that already exists in Alberta, that already we know is something industry is quite comfortable with, and is quite different than the strong economy-wide carbon price that we would like to see. However, the reality is any regulation is going to change pricing in the sector. It's going to impose a cost that isn't there now for doing business. And, I think it is, as I say, it's unfortunate that the government has made this decision of painting carbon pricing or painting all kinds of things with this brush as being a bad idea because they're linked to carbon pricing, because there is nothing that the government can propose that will not, effectively translate into an increase in the cost of doing business, and some would frame that as a carbon price. I think my expectation, and obviously, this is this is something the government will have to talk about. But if the government, I think it is clear that they are considering a technology fund. If they put in place a technology fund, the question will be asked, as you've asked today, well, isn't this effectively a carbon price? And the way I would expect the government to answer that would be to say a carbon price is mandatory, and it would go into general revenues. A technology fund is voluntary because industry can opt to reduce emissions in their own operations, for example, or to, in Alberta's case, to trade with other companies or to purchase offsets, and it's spent specifically on technology. So, think what you will of those kind of fine distinctions, but I do believe that a technology fund is something that the federal government is looking at fairly closely.